Okay, welcome into my Vanguard portfolio update. We're in a brand new year now. Welcome into 2025. And although we're only halfway through January, I feel like so much has already happened. Now, as usual, let's have a look at the markets first before we have a look at the portfolio itself. So over in the US, you can have a look here. The S&P 500, nearly 2% so far this month. May have changed since I make the video, and I'll put the latest numbers up on screen now. A bit of a rocky start to the year. I'm sure you've all been watching the markets quite closely. Quite a lot of big red days where seemingly everything's going to fall off the cliff. And then followed very sharply by a big green day where everything goes up in the right direction. Now, much of this really is just the normal ebb and flow of the stock market, as since the 5th of November, the market had rallied enormously. Seemingly almost everything had gone up straight to the moon. And really the market needed to have a little bit of a cool down as we go into 2025, after 2024 was one of the best ever years for the stock market. Now, to complete the trifecta of big tech absolutely bending the knee to the new administration, you can see here Meta boss Mark Zuckerberg getting rid of fact checkers across the Meta platform, because apparently you definitely don't need them anymore. Also announced recently was a 5% cut to the total workforce who work at Meta, getting rid of those very highly paid engineers, possibly to get some new H-1B visas in through the back door. Who knows? Anyway, aside from that, big tech is having a pretty good start to the year. Most of the names are up near all-time highs. Apple did have a little bit of a misstep at the moment with latest phone sales coming out, as you can see, dropping nearly 5% in a single day. But I'll pop the latest prices up on screen now for you to have a look at. Now, zooming out a little bit, I think some of the biggest news at the moment over in the US is all around the strength of the dollar. Now, as you can see now, the dollar has been gaining strength for quite a while now. And when you compare it to a basket of currencies like the euro, the pound, and some others, you can see it's been gaining quite a lot of strength. Now, this has pros and cons, as you can imagine. The dollar being that dominant currency that many goods are traded in just means that when you're buying things like barrels of oil, for example, you're going to pay a lot more if you're buying them in pounds or yen or euros, for example. But if you're an American and you're buying things from around the world and importing things, things become a little bit cheaper for you. Now, this all comes back to the fact that people are preferring to use the dollar and to buy the dollar, to buy that debt of that currency, because other currencies seemingly can't be trusted. And this comes back to a topic which we'll touch on later, because it does tie back to what we're talking about here in the UK when we look at our own government debt and government spending too. So as with all of these things, they're all heavily linked. Okay, what else? So much going on at the moment over in the US. Now, TikTok, everyone's favorite viral app, which personally I don't use, but I'm sure many of you do, and many younger people also look at and flicking through and doom scrolling through, has a deadline coming up on Sunday, which will be today when I release the video, where they actually need to sell the US part of the business to a US company. At the moment, I'm not aware of that actually going through, and I'll put the latest news up on screen now. However, the boss of TikTok has got a spot at the inauguration ceremony. So is it possible that some sort of deal is going to be brokered and some collection of the new US oligarchs are going to buy TikTok, or at least the US version of that? Who knows? But some very interesting things going on from the social media side there. Maybe some of the other people will put money together and buy it. We'll have to keep a close eye on that one. Now, as I film this video, we are just a few days away now from the new president's inauguration. Huge amount of speculation about what's going to happen to the markets, tax cuts, tariffs, border crisis, tech bro oligarchy, you name it. Anything's up for grabs at the moment. What's ahead for the US over the next 4 years? I have absolutely no idea. But here's the latest presidential mugshots for you. You can see here JD Vance and Donald Trump looking very, very different. Donald Trump going for those mugshot kind of looks right into the camera, and JD Vance just smiling there with a lovely photoshopped face and very bright blue eyes. Now, just before we head back over to the UK and talk about things closer to home, you can see over in the US, some of the first earnings have come out and the big banks have been reporting their numbers. Now, as you can see on screen, they've been pretty strong, and it will be interesting how some of the big tech players report their earnings as we head further into this quarter. But as you can see here, Goldman Sachs profits doubled during the fourth quarter to $4.1 billion. JP Morgan's profit rose sharply as well. And BlackRock and Citigroup also having some good times too. Now, generally, this is seen as a very positive thing for the market. If the bank's having a good time and making lots of money, then most other companies are going to be doing the same thing too. What this means for the rest of the year, I have absolutely no idea. But this is certainly a positive thing for the market, at least for the short term, before the market has another blowout and another meltdown. I'm sure they're coming, so I look forward to covering them in future portfolio updates. And as always, no matter what I say, there'll be plenty of people making videos out there talking about how the stock market is wildly overvalued, and they'll continue to do that forever, next week, next year, next month, whatever. I don't make any claims about the market and whether it's expensive or cheap. I just continue to buy and dollar cost average every single month with my investments. Anyway, close to home now, let's have a look at the FTSE 100. And I do always say this, but remember the FTSE 100 isn't necessarily a reflection on the UK economy, but it's still interesting to look at as those companies are headquartered here in the UK. You can see so far this month, at least as I record this video, things always change as they do, up around 1.3% so far for the month. Now that's in contrast to the US market that we just looked at. And don't forget, that's all tied back down to the strong dollar. Remember, the majority of companies on the FTSE 100 generate about 70% of their income in US dollar in international sales. So a strong dollar then will get them more pounds. So when you convert that back to pounds, you're looking at slightly more profits for the UK investors into that market at least. Just on that note, looking a bit deeper, you can see UK pounds are down about 10% from September 2024, obviously meaning that you get less dollars for your pound, but you will make more profit in dollars. So it all depends really what kind of business you're operating, how much you're importing, how much you're exporting, etc. Certainly from a UK perspective, generally having to buy things like oil, gas, energy in dollars on the wider market, certainly not a good thing from our perspective. Now, it's certainly been a rocky start for the new Labour government as well, trying to help grow this economy and actually get us out of a bit of a hole we're in at the moment. Now, we've had a couple of pieces of relatively good news come out, I guess if you want to call them positive news. You can see inflation numbers came out relatively good and they were well received by the market, slightly lower than expected at 2.5%, as you can see on the screen now. Doesn't mean prices are coming down, it just means that prices are only going up, say only going up another 2.5% generally across the board. Now remember, always inside of that basket of goods that are measured by the ONS, some things go up loads more, other things decrease sometimes as well. So really the way you feel the effects of inflation is totally down to your lifestyle and the things that you buy. It's always difficult when you look at these numbers because lots of people will say, well, I'm spending way more on food, for example, and rent and all these other things. And yes, you're right, it doesn't necessarily relate to the number that you see. So lots of people then get very skeptical about where this number is generated from. Now, tying this all back together with the UK's focus on growth, which is coming out at like 0.1% whatever the latest numbers that we just saw, and the feeling of trust around investors in the UK government and UK government debt especially, you might have seen the news that UK government bonds or gilts, the yield has been shooting up on them most recently. Now, very simply, the yield on a government bond, which is a debt that it issues out to the market for people to buy, the yield goes up as the price goes down. And as you can imagine, the price goes down when demand is low for those bonds. So the yield that has to be offered for those investors and other people to take that debt then will go higher and higher. Now, the effect of a low cost of a bond and a high yield effectively means that the UK government is paying a lot more to service that debt, because that's a way that they're actually able to balance the books and balance the income they get with their expenditures. Remember that the UK government for a very, very long time now, I think many, many decades, have been operating in a deficit. So we're spending more than we make. And the only way we can do that is by borrowing money. And the way the government will borrow money is by issuing bonds. And the higher that yield goes, the more we're paying in interest. And at the moment, the big story has been that there's been less faith in government bonds and the market seemingly doesn't really want any piece of it. So they've been selling those off, or the demand for them has been a lot lower than before. So that yield has been going up and up. So positive to potentially for investors who are going to get a slightly higher return on their money, but bad news for the UK government and really all of us who are going to be paying a bit more to service that debt. Now, hopefully I've given a good explanation now. I haven't butchered anything. You can let me know in the comment section if I have. Very briefly, let me just go back and have a look at wider government spending, because when I was putting this together, I was thinking, okay, well, we need to put this into some kind of perspective. You know, how much are we actually spending on debt? Now, if you have a look here, you can see that we're spending about £105 billion, at least last year, servicing that government debt. Now, that's of the total spend of £1.2 trillion. So just put that into perspective. It's a large cost. It's our second largest cost, but it's still less than 10% of all of the spending. However, you know, if we didn't have to spend that on servicing the debt, we could be spending that on far more important things like potholes, the NHS, you name it. And last year, as you can see here, we did have a deficit of £127 billion. And the more times we have a deficit, the more times we're going to continue to keep borrowing. And almost certainly we're going to have a deficit for a long, long time, regardless of whether that money gets invested or spent on whatever infrastructure projects that the UK government at the time want to spend things on. And to finally put things into perspective, the total UK debt is around £2.8 trillion, which works out to be quite a lot of money once you divide it by every single adult in the UK, and a little bit less if you want to split it across every single person, man, woman and child in the whole of the UK. Now, finally, just to wrap things up and going back to those yields, the yield has actually gone down on UK gilts as those inflation and growth numbers came out. So there's a little bit more money flooding back into that market. So it's not only it has to go in one direction. Yields can also come down as new gilts are offered and there's more demand for those gilts as well. So it's not all bad, I guess. And really, it all comes down to confidence in the UK economy, the UK government, whatever you want to call it. And there's so much at stake here. So really, there's no way to know how we get out of this hole. But hey, maybe if Keir Starmer says the word AI more times in a row, we might get some more growth in our GDP. Anyway, that's the UK. Okay, time to look into the Vanguard portfolio itself. As you can see, total value now is £63,501.54p. I do technically have an ISA with Vanguard at £12.54, which is becoming quite a joke of a meme number. I did ask for them to move it out. I can't remember if they said they were going to do that. They haven't done that. I just think it's funny now, so we're going to leave that in there indefinitely, just for lols. Now, the biggest part of the investment, of course, is in my SIP, my self-invested personal pension. As many regular viewers will know, this is what I currently use to contribute money from my limited company. And pension contributions are an allowable business expense. So it's actually a very tax efficient way to get money into an investment product. Now, the downside about a pension, if you want to call it a downside, is remember that I can't access this until, well, it'll probably be at least 57, 58 years old, probably much longer as the laws change and things change as I get toward that, whatever you want to call retirement age. I really don't like that terminology, but anyway, I'll have to wait a lot longer to get access to this money, which is fine because really it's all invested for the long term. And my focus is just getting as much money as possible into the investment. Anyway, let's click in and have a look how we've been getting on. Very simply, I know I sound like a broken record to many regular viewers, but it's always good to reinforce those basics. I just have a single holding in the account. It's the FTSE Global All Cap Index Fund, the accumulation version. So I basically invest in all companies around the world at their market cap weight, which just means the bigger the companies, the more money goes into it. It's very much the core of being a passive index fund investor and what that actually means. Really good returns so far from this over the long term. And the more you do it, it's nice to see those numbers go up. But the biggest reason the numbers will go up is because of the contributions. And that will probably be the same for most of you. So you can see, if I just go back here to the latest transactions, you can see that I put £1,000 in on the 2nd of January. I've upped that from a £500 from the company. And I'd like to see if I can push myself and get a bit more money out of the company into the pension while balancing money, paying and investing into different things that I want to do as well with that money. But certainly my goal at the moment is to try and get at least £1,000 a month from the business into my self-invested personal pension. And over the years and over the decades, that should snowball and compound as well with steady market growth, but it's never going to be in a straight line. And of course, there's no guarantees that the market will do anything, but that money does need to do something. And this is what I'm choosing to do. And remember how tax efficient it is. The more money I put in from my limited company, that reduces the corporation tax bill. And there's also no personal taxes to pay because I don't have to take the money out in form of dividends tax as well. So if you are a limited company owner and you're not doing this or you're not aware of this, make sure you look into it and understand what you're doing. But putting it into your own pension is a great use of the cash, and it's certainly very, very tax efficient. Now, let's have a look at the performance tab. I always like going on this one because I like to break things down month by month to how things are doing. If you look at the graph, that just looks like a steady rise up, and actually it's been increasingly going up, but really that's because of the contributions going into the account. When you have a look back, for example, going through month by month, you can see where there have been negative months, for example. Now, there hasn't been a negative month for quite some time if you actually look at the cumulative returns on the account, but I've done this a few times now. If we remember the darkness of 2023, there were times when the account was down more than £2,000, and I remember that very well back in toward the end of December 2022. And I made these same videos, and you can probably go back to my different portfolio updates, and you can see me saying, I don't care, it doesn't matter. And that's what I meant it. But still you get the comments of people saying, oh my God, everything's going to go, everything's going to die. And, you know, there's 40% more to go. There's a crash to hold your cash. And I just really don't believe in trying to time the market. And, but people will continue to do that forever. And I think I've now accepted that as a philosophy. And I think it's just a very human thing to do, to assume that you can just time the market. And I don't really know how many more times I can say not to time the market, but people will continue to do so. And they'll continue to buy very speculative things. But I'm fine with that. You know, that will help people like you and me, many people who watch my channel, just be good passive index fund investors. All of those active managers and active investors who think they can beat the market. And some will, inevitably, but the vast majority of people, as we know from the data, they won't. So I'm perfectly happy with my average index returns, which will beat most people over the long run. Now, on a final note, let me just reiterate some news from last month. Now, you remember that Vanguard are putting their fees up for account sizes. There's a minimum £4 a month account fee, which basically affects accounts which are under £32,000 in total. So with my account value the way it is, my fees have remained the same. So Vanguard charged 0.15% as account fee. That's charged, I think, every 3 months. I just pay that by direct debit. If you have a very small account on Vanguard, you are paying, more, and potentially quite a lot if you have a very small account. So I do say just to be careful. At the end of the day, it's up to you what platform you want to use. I do leave the platforms that I use and the links in the description below. For example, if you did want to open up a stocks and shares ISA with the likes of Trading 212, you can get a free fractional share up to the value of £100. And all you've got to do is deposit £1 into that account. They don't offer a SIP yet, but there is a free stocks and shares ISA there. So if you can avoid paying any fees, why not avoid paying the fees? It's always going to be my philosophy. But just be aware of that one. I know many of you have now moved away from Vanguard to different other platforms. And I've seen that in my comment section, and I've seen the people moving across as well. So do just be aware of that one. It's always a personal choice. I don't believe in just chasing the cheapest supplier all the time, because most people I think are happy to pay for good service and they want that brand. It's your money after all. If a company came in calling themselves Clown Investing, I'm sure you wouldn't put your money with them if they claimed they were completely, totally, fee free, etc. So always up to you, but just to be aware of that one, just in case you weren't, because not everyone looks at all their emails. And if your fees are going to slightly go up every month, and you're paying them by direct debit and you've got less than 32k invested, you might think, okay, well, where's this money going? That's where your money was going. Do check your emails, and actually you can go back and watch my last portfolio update where I covered that in a bit more detail. Anyway, thank you so much for watching. I hope you enjoyed that portfolio update. I will see you every single month, fingers crossed, if I actually get my act together, every single month of 2025. Looking forward to the roller coaster ride. As always, happy investing.